You know, have you ever stopped to wonder how Wall Street actually figures out what a tech company is worth these days? Welcome to this explainer. We're going to take some pretty dense market analysis and break it all down into a clear visual journey. Today, we are digging into a totally fascinating divide in how modern tech companies are evaluated. We're looking through two entirely different lenses: the raw, hard financial data of a mid-cap semiconductor company on a tear, and the massive global-scale sustainability metrics of a true mega-cap tech giant. It's kind of like comparing apples and, well, semiconductors.
So, here's the game plan for today. We'll start off with the ASL financial snapshot, then move right into decoding tech valuations and peek inside the earnings call. After that, we'll completely shift gears over to Apple's environmental progress and wrap things up with how they're sourcing recycled materials.
All right, so it really all boils down to this one massive framing question. How do we actually measure a tech company's true value in 2026? I mean, for decades, right, it was strictly about profits and growth. But as you're going to see today, the very definition of value is expanding faster than ever before.
Section 1. The AOSL Financial Snapshot. Let's dive right into the hard numbers of our first company.
Okay, so Alpha and Omega Semiconductor, or AOSL, is currently sitting at a market cap of $1.15 billion. That plants them firmly as a solid mid-cap player, hanging out in the exact same neighborhood as companies like Array BioPharma at $1.38 billion and Enovix at $1.33 billion. So they aren't exactly the biggest fish in the sea, but listen, in the semiconductor space, mid-cap companies like this are exactly where investors go hunting for that aggressive, explosive growth potential.
And wow, there is some serious bullish momentum happening here, up practically 30%. Top analysts like David Williams over at Needham are projecting nearly a 30% upside for AOSL, slapping a $50 price target on it. The market is clearly banking on something huge. But to figure out if all that optimism is actually justified, we've got to look under the hood.
Which brings us to Section 2, Decoding Tech Valuations. Let's really break down these metrics.
Now, these ratios tell an incredibly fascinating story. Check out that price-to-earnings ratio sitting at a lofty 57.2x, right alongside a PEG ratio of 2.4x. Let's be real, these are absolutely not cheap numbers. They show you exactly the kind of massive premium investors are willing to fork over right now just for ASOL's future potential. The market isn't pricing this stock based on what it did today, it's pricing it entirely on tomorrow's expectations.
And honestly, this creates the ultimate paradox in modern tech investing. On one hand, ASL boasts this totally staggering 94.5% year-to-date price momentum. The stock is literally soaring. But then, flip the coin, and they are operating with a negative 15.5% net profit margin. They're actually losing money on the bottom line right now. So what's the deal? Why on earth are investors throwing capital at a company with negative profit margins?
Well, Section 3, Inside the Earnings Call. Let's see what leadership has to say about their strategic vision.
Management actually handed us the answer on a silver platter during their recent earnings call. They said, "We have stepped up targeted R&D investments in areas where we are already seeing success, including power ICs, high-performance MOSFETs for AI and data center applications." Bingo! There's the magic word, AI. They are purposefully, intentionally suppressing their current margins so they can go all in on the AI megatrend. Wall Street is totally buying the long-term infrastructure story here, and they're just not sweating the short-term margin hit.
So for a scrappy mid-cap company like AOSL, that traditional valuation lens, revenue, PE ratios, future margins, that still completely dictates the narrative. But here's where we pivot. Once a tech company scales up to become a mega-cap giant, those financial metrics become just one piece of a much, much larger puzzle. The world's absolute largest companies are now being judged on a completely different scale entirely. Things like their carbon footprint, their use of recycled materials, and their overall environmental stewardship.
Let's look at exactly that in Section 4, Apple's environmental progress. Their 2025 progress report is the perfect case study here.
Just take a second to wrap your head around the sheer scale of this mandate. 17.8 gigawatts of clean energy is now supported by Apple's global supply chain. That's enough power to run whole cities. And remember, this isn't just Apple's own corporate offices. Those have actually been running on 100% renewable energy since 2018. No, this is their entire supplier network scattered all over the globe. When Apple decides to transition to clean energy, they basically drag an entire global manufacturing sector along with them. It's wild.
But, just reducing emissions isn't going to cut it anymore. They actually have to remove the carbon that's already out there. Enter the Restore Fund. Through this initiative, Apple is pouring heavy investments into high-quality nature-based carbon removals. For example, they're currently working to restore previously deforested areas of the Atlantic forest down in Brazil. They're bringing back native tree species and literally revitalizing entire ecosystems from the ground up.
And the data here completely shatters an age-old corporate myth. Since 2015, Apple has achieved a greater than 60% reduction in their gross greenhouse gas emissions. But, and this is the kicker, in that exact same time period, their revenue shot up by over 65%. Oh, and they also avoided 41 million metric tons of emissions this year alone. It just proves once and for all that you absolutely can decouple carbon emissions from massive financial growth. You don't have to choose between the two.
Now, Section 5. Sourcing recycled materials. Let's talk about how these lofty goals actually translate to the hardware in your pocket. Apple is moving at lightning speed toward their ultimate goal of using 100% recycled or renewable materials. Just look at the numbers for 2024. 99% of the tungsten used in their products came from recycled sources, 76% for cobalt, 53% for lithium. Oh, and they are also using 99% recycled rare earth elements in literally all of their product magnets. This is a staggering logistical achievement that is fundamentally rewiring global mining supply chains as we speak.
And this massive sustainability mandate, it's fundamentally changing how hardware is designed. Think about it. The most sustainable device is simply the one that lasts the longest. So, Apple is really pushing product longevity through ultra-durable designs that hold their trade-in value for years. But they're also making them way easier to repair. They've just introduced this incredibly cool new process that uses low-voltage electricity to make battery removal faster and way safer. It's completely changing the game for how these devices can be serviced and kept out of landfills.
So that brings us right back to where we started today. We used our slides to explore the massive PE ratios and AI dreams of a mid-cap semiconductor stock, right alongside the gigawatts of solar power backing a trillion-dollar mega-cap. And the big takeaway here? To truly understand modern technology companies, you have to synthesize both approaches. You absolutely need the traditional financial lens, but you also need the modern sustainability lens. Because if you are only staring at a spreadsheet, well, how much of tomorrow's true value are you actually missing? Thanks so much for joining me on this explainer, and I will catch you on the next one.